Alrighty, folks, the 11th, Tuesday. Welcome to the live stream, Patreon, YouTube. Wherever you are, please join us. And reminder once again, you can post your comments anywhere you want. You can post them in Patreon, you can post them here on YouTube, you can post them in Discord in the dedicated channel. We're going to answer all of them. But before we do that, folks, just give me a little bit of feedback here. We're looking at the SPY 3 minutes chart. If you see the picture fine, you hear me fine, just let me know. We begin right away. Okay, folks, thank you so much. Let's begin here. When we say that we have promising signs, but are they enough? We're going to revisit the morning brief that I gave you this morning, and we have some conditions. If they're all met, at least we see them formulating, then we have really good sign that, okay, we're getting really, really close here, or if maybe the bottom is already in, and we're going to begin to rebound. And of course, when you do a rebound, you're going to do a retracement of some sort. So if you use Fibonacci, so you got your top, suppose it is the bottom, right? You're going to see a retracement of some sort, at least 2360 or 3820 or even 50% retracement. So you'd see a sort of a rebound, and then we'll see what happens after that. If things change in the policy and the narrative is fixed, then we could have in time, of course, we're going to have a process of a recovery. But usually, as I said before, a drop like this is indicative of a shift from bull to bear market. And what's going to happen is we get a rebound, then we come back down again, but one step at a time, folks. The question is, do we have the bottom right here? Let's explore. So we're not going to look at the SPY because we have to look at other components. And among the conditions is the VIX, of course. VIX is the most important one. And if I look at the hourly chart in the VIX here, I'm not seeing signs of weakness still. I'm seeing maybe a sign of a double top right here. I usually like to look at the 2 hours chart in the VIX. It's just a cleaner chart for me to visualize everything. Maybe, see if we take 2656, that's the support that I got right here. If we take it, that's going to be a promising sign that, okay, next stop would be 23. And then once we lose 23, then we have a confirmation that, okay, this is as far as the VIX is going to go. And it's going to begin to head down and play out that process of a rebound. So we don't have the VIX yet. What do we have? Do we have, let's see, crude oil here. If we look at crude oil, you need to see a rebound in crude. You cannot really have any alleviation from recession fears without a move higher in crude. And the number here, folks, that I'm eyeing is 68 in crude oil. Why? Because we could see crude trading positive as we've seen right here, once again here, but we need to be sure that the move in crude is for real, that we found some sort of a bottom for real. So this one is looking a little more promising because we have a low here. If you look at the wick of this chart, we have 65.22. We got a wick today at 65.29, so at a higher level. We got a wick. But again, is it really enough without a close above 68? Not really. Are there any promising signs? Yes, you see the positive divergence in the RSI. That's usually promising when we see it trading this way. But again, we've seen some of these before and it did not work out. So we don't want to jump the gun here, but it is a promising sign from crude oil. Now, the third one is, if we look at the 10-year yield, US 10-year, if we look at that, we want to see the same thing here. We want to see, so is there a promising sign? Yes, promising sign because we have a higher low. We have the possibility of a change from bearish to bullish momentum. We also have in the RSI right here, you can see the positive divergence. So all of these are good, but again, you need to look at a number such as 4.3, for example, as a confirmation line, because once we close above, we got rejected here, and then again here, you can see the rejection before that, right around here. So 1, 2, 3, 4, maybe 5. Closing above 4.3 will be a confirmation that, okay, at least we're moving higher here, and we got a confirmation. So again, promising, but not enough. How about the IWM? If we look at the IWM, the IWM is trading positive, and then you look at the Qs, triple Qs, not the double Qs, triple Qs trading positive. SPY maybe a touch negative or a touch negative. So we see the IWM outperforming relatively, but it's still not enough. We need to see the IWM up, let's say 1%, 0.9%. We need to see a sort of a aggression a little bit in the IWM, and it's not there yet. Maybe it's going to happen by the end of the day, but right now it's not there. Now we look at the Dixie. And the Dixie is going down, so we still have some recession fears here. So the Dixie is not giving us confirmation one way or the other. BTC, if we look at Bitcoin, are we at the 200 or above? So plug in the 200, we're not above, but it is positive. If we continue to trade like this, maybe it's going to be a bullish engulfing candle. It'll be promising that we might try to close above the 200 days moving average. And if we look at the last one, which is risk on, outperforming risk off, we see that sign. That's perhaps the most promising sign. I'm going to keep it at the SPY here, just in case anything happens. And we look at the movers of the day. So you look at the losers, some of the names in travel went down, but you see Verizon down 6%. That's interesting, right? Verizon is among the risk off segment, which is down big. We see names such as, I was just looking at J&J, for example, which is a classic name for a defensive. That's down on the red too. You see some of the names that we talked about in the stagflation portfolio, like Procter & Gamble, like Amgen, like Gilead, like if you look at other names that we talked about, like Bristol Myers, like Deere, they're lagging. So that's a good condition here to see in the risk on rotation, or aka the rebound or the temporary bottom. Then who's leading? Okay, we got Neo, Southwest, that's irrelevant, but we have a lot of the heavily shorted names like Supermicro, like HIMS, momentum names like GE Vernova. In the data centers, AppLovin up about 6-7%, Lemonade. AVGO, that's a big name that is rebounding. And yesterday I said that if I'm going to play a rebound, AVGO is one of the best that you can do because the options are way, way cheaper than NVIDIA and any other names, really, you can think about. Palantir leading the way, Tesla leading the way. So you see a lot of the retail traders / the heavily shorted names leading the way. That's considered risk on. And they're moving higher while we see risk off stuff moving down. If that was not clear enough, you see it in the map right here. Who's leading the market? Tesla, Amazon, Meta, Microsoft, NVIDIA. You see AVGO, you see Palantir, some of the software names finding a footing. Not so much in the banks yet, but we see healthcare down. We see the classic utilities down. We see Exxon down, the safety in oil. We see the staples down, pulling back. We see the telecoms down. So the market is trying to do it. But again, as you've seen the news today with the tariffs against Ontario, that's going to be a problem. But it is a good sign if you manage to close positive today, folks, in the S&P. If we manage, keyword if we manage to close positive, it's part of market behavior when it bottoms, that it bottoms in bad news. That you have, the tariffs against Canada is now up 50%, doubled. But the market decided to ignore it either way. If that is the case, then sure, you're going to get a solid sign today that the risk versus reward would say, buy the dip a little bit, begin to add some risk on, and be serious about the rebound plays. But it's not enough yet, folks. If we look at the zero DTEs today. We're sitting at 558. A reminder, you want to see the volume right here, and the volume of the next strike out of the money, at least two of them. Is that with a higher volume than the puts? And if it is, then the calls have the advantage. Let's see. So in the puts, we have 559. That's a 69 versus 57. So the puts got the advantage here. The 558, we got 72,000. Here we got 60. And then 557, we have 88 versus 560. So slight advantage right now to the puts. And this is why you see the SPY kind of stalling here and not moving one way or the other. That's going to change, of course. So if we go back to the bar chart, how would that change? If we begin to move to 560, what's going to be in the money? Huge contract that's in the money, and then you see 84 at 71,000 here in the next contracts. If we go down to if we do here, we go to up to 560, then we're going to have lower number of contracts that are in the money in the puts and lower number of contracts that are near the money in the puts. So if you begin to see the tape in the SPY leaning toward 560, so we're going to identify 560 today. If we begin to trade above, comfortably so, because today, I mean, when you see the tape opening right around here, well, we traded a little above, now we're finding resistance. So this is not a coincidence here, folks. 560. See the rejection that we just got here as we got on live. So if we begin to trade above, I would say that's a good sign, at least for today's session, that from a mechanical perspective, we can do it. So keep that in mind. But anyhow, folks, these are my thoughts about all of the notes that I got for you. Let's see what you guys have in the comment section here. Stefan, small family office. John, good morning, everybody. Let's begin here with Stefan. It says, I grabbed some TSLL calls this morning for a rebound play. We'll let them ride as long as the VIX continues to sink. So I gave you all the signs here, and perhaps a really good sign would be the 560 here in the SPY. And TSLL is the proper way to play a rebound in NVIDIA. Why? Or excuse me, in Tesla, because you don't want to overspend. You don't want to overspend in the options. So if you go to Tesla, I mean, you look at the daily chart, sure, we got a rebound out of 218.72, which is the gap. Granted, but we're still below. If we plug in here, give it a minute to show up the 200 days move, we're still below. We're still within the body of the engulfing candle here. So for all you know, it's not out of the woods. And this is why we don't want to overcommit. So if you go, for example, and try to play a rebound here in TSLA, and let's say we go to next week, we're just going to go to 235, a 7.6%. Now you're spending $1,400. That's a lot of money. If you look at TSLL and you go, for example, for the 8.7 or 8.7, the next is the nearest one. I would not go beyond that. But even if you go to the 7.7, which is more reasonable, it costs you about $125, about $125. And your chance of profit is 37%. Even if you go to the 8.7, you're spending about $80 and your chance of profit is 31. Reminder again, if you go with Tesla and you go to 235, chance of profit 33, but again, you're spending a lot of money here. So it is the proper way to do it. And I would say stick with it for now. It's looking okay. Tesla's positive. Cut loss if Tesla loses 218.72. Greetings from Vegas. A little cloudy today. Good morning, France. Mike. Appreciate that. Let's do Asta. Hey, this might not be a popular question, but I wanted to ask. What percentage of your gains do you allocate to savings? Well, it is a popular question because when you make gains specifically in risk-on assets or stuff that you're not really confident it's going to work out in the next period of the economy, what I usually do when I sell a stock, immediately, the moment I sell a stock, my question is the percentage of the returns that I'm going to get if I park the money in the broker, if you just keep the money in the broker, because sometimes the broker has already a deal with a money market fund where they use the client's money in the money market fund and they get a return out of it, or they have other access to federal facilities where they can get a better interest rate. So let's say if I'm getting 4.7, for example, which is a high number for a broker, is that good enough, or can I go with, let's say, a note, a shorter yield? Here in the 1 year, for example, we have 4%. If you buy it right now, you'll get 4%. So I would usually park the money once I make any returns from a stock. I would park the money either, if I don't need it right away, I'd park it in something like this, the 1 year government bond yield, or it's going to be in the broker account if there's a return on it that is better than, let's say, money market fund. But the idea is while the money is waiting, you want to get some yield on it until you figure out the next move. Do you keep it in the money market fund, or do you keep it in the brokerage account, or do you switch to a stock position if an opportunity opens? So usually all of it. The moment I sell, I usually find a way to earn that yield. Okay, good question. Fool's Errand. Mav, I was intrigued one day when you said sophisticated trade. Are bear call spreads something sustainable? Bear call spreads is what we call a call credit spread. So that would work out in, let's say, if you look at Amgen, stock that's been going on higher because it was considered as risk off. It shows signs of topping. It is overbought, right? So the anticipation is, as a shareholder, this was and still is a great point to sell a covered call. So if you have 100 shares of Amgen, you sell one call at the 235, or excuse me, 335, or even 325, 320. Some folks will sell in the money, 315, and raise some cash from that. So if you look at Amgen, if you don't think it's going to trade above, let's say, 325 by next week, you can sell those and net a credit of about $500. That's called a covered call if you own the shares. Some folks will use that money to hedge, and they'll buy, for example, the 315 just in case Amgen begins to flush down, right? You buy the 315, now and you're getting a credit. You're getting paid for that insurance policy. Now, your question is, can we do call credit spreads? Yes, we can. But in this case, what you're doing here is you're selling the 325, for example. You're buying the 335, right? You're raising cash by $300 in net credit. And then your max loss is the difference, 325, 335. If the stock goes above 325 all the way to 335 and beyond, your loss is limited to the gap, because once we go above 335, you're covered by the one that you bought right here. This is the buy, this is the sell at the bottom. And this is why this is your credit, 300. Your max loss will be 700. Usually we do these in stocks that we don't own, but we're positive that there is a top, at least a short-term top, and the stock is high enough in the 300s, 200s, maybe more, we can raise some credit that is worthy of the trade. But usually if you own the stock, you do just the covered call. You sell the covered call because you're selling the same quantity that you got, and the worst outcome is if we go above, you sell these shares at 325, which is considered a profit versus the current price. So these are the strategies that I would do. Now, you might talk about perhaps a more proper question or example. Can you do a put credit spread, also known as a bull put spread? In the case of Tesla, for example, some would argue that it is oversold and the downside is limited. So one strategy would be, if you go Tesla and you go with a put here, let's say within a next week, we don't see Tesla below 220. We don't see it. So when we go long put, I actually want to do sell a put here. So we don't think that Tesla would be below 220. So we're going to sell that. It gives us a credit of about $1,100. But what if Tesla collapses, right? What if it goes down? then your max loss is going to be huge, right? You're going to lose a lot of money. So we want to stop that. So we buy the insurance policy at either, let's say, the 210. So the max loss will be the $10 gap between these. But again, I'm raising a credit of about 325 here. Max loss about 675. So I know what my loss is. Maximum loss if Tesla collapses to 200. My maximum loss is going to be right here. But I know that if Tesla continues to trade higher, and we got a bottom in the market, and let's say it does this, maybe a retest of the 200 next week, and then it comes back later on. After next week, the expiration is over, the 21st, then you net the whole credit, the $330. So I think that the put, we call it a bull put spread here. Or again, for lack of not confusing ourselves, we can call it a put credit spread. It is more appropriate when you see stuff like this. And again, in the call side, when you see stuff that went higher and getting overbought in the RSI. Really good question. Senior, good morning, boss. Short-term calls on IBIT for a rebound. So we're looking for Bitcoin here. Short-term calls, maybe. But I would say we're not out of the woods. Bitcoin is rebounding along with other risk-on assets, but it's still below the 200. For all you know, it could be a dead cat bounce, and then lower we go again. I would say wait till we get closer to the end of the day. If we close in a bullish engulfing as we're doing right now, okay, now we got a case. But it's a little too early to jump the gun. And if I'm reading the situation correctly here, I think you have a strangle and you're trying to hedge against the strangle, at least the put leg of the strangle. So I would not recommend it right now. You're not there yet. You need to see solid signs that the Bitcoin is going to rebound before you do that. No big rebound in Carvana. So Carvana, let's see here, Carvana, it is up though, so it's not declining. And if we look at the daily chart, we're not even looking at the 200, but again, it's below the 200, so it might retest the 200 and then come back, but it's still not the most convincing one. So what I'm seeing is, in the rebounds and the risk on, I'm seeing Palantir, I'm seeing Tesla, I'm seeing the popular retail names, which tells me that retail bought the dip, and that's contributing to the rebound. Now, retail usually has the tendency of doing that, like in HIMS, for example, and the next thing you know, the market goes down. And the problem with that, this is really important for everybody listening right now. The problem with that is if we have another scare, let's say in tomorrow's session, the problem is the retail investors who bought the dip today or overnight, they panic, they exit, and they exacerbate the move to the downside. So keep that in mind. This is why I say that we're not out of the woods yet. By the way, can you still hear me here in the stream? Because it might have been a connection issue. At least my TV froze. So if you can hear me fine still, just let me know in the comment section, please. Okay, thank you so much. Just want to make sure here. So that's Carvana for you. Let's do math. My GEX is still highly negative. Do you still feel we can rebound today with the VIX above 25? So you're looking at GEX. That's an indicator that a lot of folks love to look at. It's useful. It gives you good information. It's not lying to you. So I look at the volume right here in options, right? You're looking at GEX, that's fine. And again, the VIX is not giving any sign that it's done, right? It's just consolidating here, building some energy without a loss of at least 26.56. No, we don't have any signal from the VIX to say that, yeah, you can go ahead and buy the dip. It's a little bit risky right now. Could you walk us through trading in a volatile market again? Of course, wait would be good advice, but sometimes, yep, I got you. Okay. So trading in a volatile market, let's say bear market. Bear market is usually a volatile market. How do we trade in it? You have to understand that the trend changes. So if we clean up the chart here and expand a little bit, in a bull trend, as we've seen, let's say 24 all the way to this year. So you have a series here in general. You have a series of higher lows and the dips are bought and we get rebounds. So you as a trader you go with longer dated calls, even if you go with a decline like this, which is big, that could decay your call options, the rebounds are almost guaranteed. You get scary once in a while, like you have a lower high, you might head down and all of that. But so long as the trend is intact, and you can see that clearly in the weekly charts, so you'll see the wave. And if there's no threat that the wave is splitting like this from the average, as we see right now, then the bullish wave is still intact. And your job is longer dated calls. And once you see, say, a weekly chart like this, where you have a bearish engulfing candle, as I'm pointing right here, which is a sign of a reversal, you buy some shorter dated puts. So if you had 2 months out in the calls, you're buying about 2 weeks out or 3 weeks out in the puts to hedge against that. Once you're done, you're back above trend, you close all of your puts, and you rely or use the profits to double down on your call position. In a bear market, it's quite different because the trend changes, so you will have a trend that is downward like this. You can see it here, that the trend is below zero in the MACD. And so long as we stay below zero, there's no threat that we're seeing a bottoming in the wave and higher we go, as we've seen closer to here above the zero line, when we got to, let's say, 23. You're still in a bear market, and your job is to have longer dated puts. And once you have signs of rebounds, signs of oversold conditions, or in the weekly chart, such as the wick that we got right here, your job is to buy shorter dated calls to play those rebounds. And you have the trend intact, of course. You have to look at the trend. Okay, we got to the trend. Now, I have longer dated puts that are 2 months out. I'm going to add to them, and then you ride the wave to the downside. Again, you get oversold in the chart. You see signs of a bottom, like right here with this candle. Let's add some calls, retest the line, then use the proceeds to buy or add to the puts again that we got. They're 2 months out. So that's the strategy that we usually use here in a bear versus a bull market trend. And it appears, I mean, look at this. This is a clean break in the trend. And what's going to happen is we're going to have a little bit of a battlefield where we see a rebound, and then we begin to form a bear market kind of trend. That's the assumption. If that is the case, now you know. The strategy is longer dated puts, and then you complement them with shorter dated calls when you see signs of bottoming. 560 SPY, folks, is a really important number. We'll keep an eye on that. Really good question here from Small Family Office. Senior Spooky. You got a small position at the trade desk at 80 calls for April 17th. Okay, you got the 70, but you got a longer expiration date. Should you grow the position more by averaging down or just cut? Well, we don't have signs yet that we're through. Okay, so if you feel safer that you cut, I mean, it's way oversold. The moment we get that risk-on rebound, it will participate in a big way. Problem is when, right? Because it could be a falling knife until that happened. So if you feel that this is slipping out of your way, you still got all the way to the 17th, the 80, you're now way out of the money. Maybe cut it. Let's see if we get solid signs that we have the risk-on rotation or the bottom or the rebound. And then you add it. And then you're going to have plenty of meat in the bone to chew on. It might pop all the way to 85 and then consolidate and does what it does, either coming back down or continuing to move higher to close the gap. But you can afford to wait, but you cannot afford to wait holding in the position because it's going to decay. So my suggestion will be with today's action, let's get out, reassess again. That's part of, by the way, the trading and trying to catch a bottom versus catch a falling knife. You get in, you take a shot, this is the bottom, doesn't work out, okay, cut it right away. That's a really good discipline for you to pick a bottom, is to cut the loss quickly when today's not the day. Leo, we exited the 565 puts yesterday. What is a good re-entry trade? SPY puts naked at 560. I would not really enter puts at this point because you're going to overpay unless we take the lows and we see here a possibility of a zero DTE. Maybe you can play zero DTEs or let's say 1 day till expiration or the weekly expiration. You can do that. But I would not overcommit in the puts because risk versus reward says that we're nearing a bottom. So when you're nearing a bottom, The VIX is probably too high for the options and you're going to overpay. Now watch what happened here. We're trading at 556 right now. Look at the numbers in the contracts in the money, the volume, traded in the money and the volume out of the money, slightly out of the money. And then compare that with the volume in the money and the puts and slightly out of the money. And of course, when you see the column going here, that's the closing. The column going to the left, it's the opening. So we still have opening at the 555. That could be the inflection number. That if we get to 555, that could result in a slip down and we go back to 550. So that could be an opportunity for a bearish trade for the zero DTE perspective over the weekly options. But as far as like, let's say adding April puts right now or anything beyond that, I'm not seeing a strong signal to do that at this time. So I would say book your puts that you got for later in March or April. And then maybe you can roll down with the portion, say 20% of your profits in a weekly put options trade if we take that 55 number, because it solidifies that maybe we slip down to 550 at the end of the day. And if you have the weekly expiration, you have enough of a buffer to play that one. You can play it via the 555 50 put spread or the 550 naked. A friend listened to the Tesla heads and is down over 50%. Unfortunately, I know people who are in the same boat here, unfortunately, because the propaganda is huge in social media. You have all of these people giving you charts. Oh, this is what's going to happen when I find the bottom and Tesla's going to trade the 800. They just draw a bunch of garbage on the chart, and somehow these are experts. And unfortunately, this is the way we trade these days. Everybody's an expert. Everybody can put a chart out there and get a lot of likes. It becomes popular. Other folks look at it and say, oh, well, maybe I should be buying Tesla. So I know people personally here who are sitting in a lot of pain right now. But your friend here is down over 50% on TSLL. Would you recommend cutting loss sometimes, or just wait for a weekly bottom to DCA? Well, the only choice you can have right now, because if you exit, you're waving the white flag. When you're already down 50%, that's not right. You got to look for a rebound or retracement. So if we clean up the chart right here, again, let's use Fibonacci. Let's say top. Assuming this is the bottom, you could get a rebound and maybe exit at, let's say, 15 if you're lucky, or 12. And now at least you made up some ground. But I would say you look at the original chart of Tesla. Cut loss, meaning that we have more declines to come, is taking the support of the gap, which is 218.72. So right now your friend can either average down if they're brave, average down on their TSLL shares, so long as the chart of Tesla is trading higher here and not violating 218.72. If it does, then we got more pain to come, and at that point will be better to exit. But right now, either wait for an exit at a better price. Maybe you can exit with a loss of 35% or 30% instead of 50%. Or if you're brave, you average down by buying right now. And once you get that rebound, maybe now you can exit at a loss of 20%, 15%, which is a lot better than 50%. Maybe you can even flip into a profit if there's a big rally or a rebound. Senior, you said Apple breaking is a bad deal. And I agree, but it doesn't seem like the 6% drop hurt the market yesterday. Is there more to come? So you know what the interesting behavior today is? If I refresh this map right here, Apple is down 2.5. So Apple been trading with the cohort of the big pharma, the telecoms, the Verizons of the world, the defensives. So the message by the market right now is we're trying to shift from safety to risk on, from Apple to NVIDIA, from Apple to Amazon, from Apple to Tesla. So that's how Apple is trading right now. And if that sentiment continues, then I would say that if you see the risk-off stuff like the big pharma coming back down, then Apple should be trading down with them. But if I'm just giving you my 2 cents here on how I read the psychology of the market, if we get a confirmation of a bottom today, we begin to rebound tomorrow, you will see Apple participating with the risk on. You're not going to see these guys going down big as much. Maybe they're going to lag. They're going to lag, but not go down as big as they are right now. Because today could be the shift day, the rotation day. We see big declines in the safety, and then we see at least some big pops in the risk on. But after that, it stabilizes. And I think when it stabilizes, we see buying of the indices, and that alone pushes Apple back up in the green. So Apple is going to be one of the toughest names for the bears to trade in this environment because it is considered as safety. And at the same time, with the market rebounds, just by the sheer weight, it catches a bid and it also performs on the way up. So this is why we see Apple been holding like this. So it's not going to be the easiest name, but right now it's below the 200. It's below 220. So we have good signs that we could see more pain to come for Apple. I like to look at the 50 on the weekly chart. So you don't want to lose the 50 because when you lose the 50, you usually have a few more weeks of declines. And that's a confirmation of a bear market. I don't have to point for you the obvious, the topping in his shoulder. All of these are warning signs. So I think we have more downside in Apple, but I would say be careful because it could participate with the risk on if that cohort catches a bid in a rotation. Which again brings us back to the strategy of longer dated puts, shorter dated calls. Looks to me like a clean rejection here at 560, folks. Short Palantir up big. Should I sell some covered puts out of the money? I don't think. I was thinking about that. That's funny that you say that. I was just thinking about that because I got a short in Palantir. I was thinking to do the same thing, but I'm not convinced that we're done. The RSI is not oversold yet. And as I said, if we look at the 50 weeks moving average, so long as we're trading below here, we're going back and forth, this is going to be a bear flag, and we're breaking down on, I don't think we're done yet. I think it's a weaker rebound, and I would not sell the covered puts until we get to the lows right here. And the low would be 63, so if we get to 65, 63, then yes, I'll begin to sell covered puts. Covered puts meaning you have a short position and you're selling the puts. Same thing if you own a stock and it goes higher and you're selling a covered call right here. So if it passes above, your obligation is to sell at that point. In the short side, if you sell it right here, stock goes below, then your obligation is to cover you short at that point, to buy the stock. And you can, of course, roll it down at that point. There are a lot of strategies you can mitigate, but right now I would not do it because we could see acceleration of the momentum to the downside again in Palantir. And then your puts are going to be in the money, and it's going to be a pain in the ass to mitigate that quickly. Okay, Morgan Stanley published Tesla target 800 at 2025. Again, I don't know who these guys are or what they're thinking about, but there's a lot of propaganda with Tesla going on. And we know who's doing it, right? It's folks who bought a long time ago in 2020 and before. And they want other fools to come in and push the stock higher for them. And it's criminal because a lot of folks getting hurt here. When they buy and they chase the momentum and then they go down 50%, they go down, it's painful. But hopefully that at some point you get stung so many times that you learn the lesson. Because there are folks who bought right here and they just want somebody to pump the stock higher for them because they've been stuck. I think in a stock like this, if you look at the monthly chart, it tried to rally so many times it couldn't. I think at the end of the day, it's going to settle down below 100. It's going to make lows below 100 and settle where an automobile manufacturer should be trading at. It's not a bad company. But now, of course, it's involved with the politics and Elon Musk, so there was a big backlash, too, against Tesla, and it just makes it a volatile asset to be in. Ryan, good morning, Maverick. Again, thank you for all you do. I appreciate that, Ryan. NVIDIA Iron Condor. I did not manage the trade well. I was assigned 100 shares of NVIDIA at 120. However, I did have a put. You rolled the put 270 with the expiration date of the 17th to lock the profits and still be in the trade on the downside. You sold at 111. You sold a 111 calls with the expiration date of this Friday, receiving about $300. What are your thoughts now? Not a strategy. Okay, so let's look at the situation here in Apple, or excuse me, in NVIDIA. If you look at NVIDIA now, you sold some puts. So you sold a put here at 120. And since we're trading below 120, you got a sign. See, when you get closer to the expiration date and you deep in the money, in this case, you sold 120, right? So we're deeper in the money, closer to the expiration date. So somebody exercised here the puts that they bought because they're confident in shorting NVIDIA. But your obligation as a seller is to buy it. So you're buying it right now. You're sitting at a loss, obviously. What do you do at this point? I would say so long as we keep 106.30, you're probably going to get a rebound in NVIDIA. And maybe you can exit that position of 116, 118, even at a profit and get out of it. So you're not really in a bad position right now, super bad position at least. And then you rolled a 270, or I think 270 is a little too far. Maybe you meant the 170. The 170 puts expiring on April 17th. So that's deep in the money too. And that might exercise for you. But if it exercises, you're just going to short NVIDIA at 270, so no harm done. And this is a good environment to be short NVIDIA, so I wouldn't worry about that. You sold the 111 calls, though. That's the one that worries me, because if you sold it for this week, you're getting really close. And what happens if you sold the call, then you have to buy again at 111. So maybe that could be your averaging down strategy, that if you're going to rebound, and again, we're at 117 by Friday, I want to buy at 111 because I already bought at 120, right? So I want to buy at 111 to average down, and that way I don't have to go to 120 exactly to get out of the trade at the break even. If I go to 118, maybe it's going to be enough. So you got a good strategy here. So long as you did not sell in the quantity of the covered call, of the calls, excuse me, the 111. If you didn't sell a bigger quantity than the position that you own right now at 120, so long as if you didn't do that, you're good to go. I think you got a really good strategy here. I appreciate that, Ryan. So there's nothing I can add here. I think you got a good strategy. So this is what happens, right? Sometimes you sell a put, gets deep in the money, it's exercised. Now you got to buy at 120. So what do we do here? Line in the sand. If we go below, then no, we're going to do something else. We're going to buy we're going to buy a put, for example, or just sell the shares altogether at 120. That we bought at 120, excuse me. We sell them right here at a loss, because the loss here would be better than more declines. But right now, the odds would say that we're probably going to have a rebound, and either you're going to exit at a profit, or if you average down by the 111 call, you're probably going to exit at a profit before 120. So stick with it for now, but loss of 106.30 merits thinking about exiting the position altogether or buying puts, because the puts will guarantee that you can exit at the price. If you're choosing, if you go with 105 puts, you can exit at 105. So your loss would be 120 minus 105. It's going to be $15 a share. Say NVIDIA is trading at 100 or below at that point, still better loss than what you would have done if you just held on the shares. Apple is flushing. Let's look at Apple here. Yeah, a little bit, maybe contributing to the SPY, because it lost 220, which is an important number. So we'll probably have sell orders at 220. Oh, the 70 puts, not the 270 puts. You rolled it to the 70 puts. Okay, but yeah, that's a different position though. The 70 puts is separate from the stuff that we have right now, because the 70 is way too far. It's not going to protect you really. If you had the 270, I would have said you're fine, or the 170 rather. But if you have the 70, then yes, you more than ever. If we close below or lose 106.30, which is my support here, you probably want to buy a put closer to 105, just to mitigate some of the losses from the 120 that you got and hedge a little bit. Now, if you had the 170, I would say you covered. Doesn't matter if we go down, because you got already short the name at that point. But yeah, if you have the 70, it's a little too far. Not going to protect you right now. Mav, I love the morning brief. It helped me very much. Thanks a lot. Appreciate that. And a little too early today, but I was up, so why not? High put volume since forever. What about a possible short squeeze this week? It's a possibility. So if we look at the SPY, go to the weekly expiration of the 14th, you're not going to see a lot of tradable volume here. No risk here for a call, obviously, because we're not seeing a high increase in open interest or OI change, and the volume is low. The volume is going to, of course, translate to OI change tomorrow and a change in the open interest number. Any chance here in the puts? Yes, because we have higher open interest at 24,000, but we have 24,000 open interest. The volume is exceeding the open interest, so my hunch is they're opening 555 puts. And then they're also doing the 550. So there is a possibility that we could squeeze by the end of the week or even by today all the way to 555, 550. That's a possibility. If we see acceleration of the buying of these contracts, yeah, the market maker could do that. So right now, believe it or not, the puts, the bears still got the advantage in the market, despite the attempt for a rebound. But today, I would look at today as sort of a battlefield. Some folks are saying, okay, this is enough. Let's rebound. Let's cover some shorts. That's why you see Supermicro up. That's why you see HIMS up. But there's another cohort in the market that says that we're not done yet. Not seeing the signs that make me confident. And whatever news that we got, that we're going to double the tariffs against Canada, that's not a good one. Let's see here in the Top Guns chat channel, folks. Not the Q&A. Q&A, that's for the longer videos, longer dated videos, something that you need to be answered. If you get it a month later, you're okay because it's a topic for a video. But the Top Guns chat is where we answer questions. Diamond Hand Joker, you say the time zones screwed me. In Arizona, I'm trying to be nice, so it's early in the morning, but I'm going to start swearing really soon. In Arizona, stock market opens at 6:30 now than 7:30. Well, it takes a little bit of time, but gotta adjust. So today we did the stream at 8:30 because I'm also facing the same issue. So if I had done it 7:30, that would have been 6:30 here a few days ago last week. So that's not a permanent change, by the way. We're just gonna stick to 7:30 Pacific time in the next stream. But right now, we did it because we needed a little bit of clarity on the charts. Franklin, FYI, it looks like the scenario you mentioned last night in the video is playing out with the Dixie higher, VIX higher. No. We want to see the VIX down. We don't want to see the VIX higher. We want to see Dixie higher. I mean, maybe you're talking about the crash scenario, right? The Dixie's higher, VIX higher, ETFs down, bond yields down. Sure, but the dollar... Let me look at the dollar here. It's not really higher by a lot. The dollar is weak today, so I'm not seeing, it's not even trading positive, the dollar. So I'm not seeing it here. If the dollar was trading in let's say, a falling wedge breakout or a bullish engulfing, yeah, would have been a big deal. But we don't have the conditions yet. Mr. Mad Hat, you say I sold most of my longer dated 30 days plus puts this AM. Okay, that's a good choice. On Apple, SPY, AMD, great. You're up 70, 80%. That's great. You book the profits. Some folks will sell a spread, but if you're capped with the profits, you book them. Now you got to wait, see if supports are broken, see if what Franklin was talking about, if the dollar is up, VIX up, ETFs down, bond yields down, then there's more downside to come. And at that point, maybe you want to add. But I would say right now, the risk versus reward would say opening new puts will cost you a lot. So we don't want to be in a position where we put newer puts, and then at the same time we see a rebound and we see a decay in these puts, and now we're stuck in them and we have to average down on all of that. This is why I would say you keep some position, you keep some short exposure until the confirmation of the rebound. Once you get a confirmation, you exit all of these puts, we place them later again. But right now, I think that the risk versus reward would favor the rebound plays. But of course, the risk is you got to see the initiation before you do the move. You got to see the confirmations that I gave you before you follow the move, because today it looked promising in the morning, but right now, not so much. We'll see how it looks at the end of the day. Maverick, is there a time frame you prefer for your main reference for the shorter dated options with the bigger trend, depending on the stock? Yeah, sometimes it's the weekly usually would make sense, but I would say 2 weeks to be safe. So your puts should be 1 month at least, 2 months ideally out. Your calls, the counter trend, in the case of a bearish trend, should be a week, 2 weeks out. Adnan Malder, you say, why do you, when you say go short, what do you mean? Short meaning that I'm borrowing the shares. So for example, Palantir, I'm short, meaning I don't have put options. What I have is I borrowed a bunch of shares when we talked about it before, I think around here. Shorted some shares. So when you say short, I mean I borrowed Palantir shares at 115. If the stock goes down, I can return those shares to the broker at that I got at that I sold at 115. Because remember, I borrowed the shares. They gave me the shares at 115. I can buy them back at the current price right now, 78.75, and book the difference. And that's going to be my profit on the short. So this is how you do a short position. You take it at price, it goes down, you return the shares to the broker, and you pocket the difference. Maverick, what indicators would you track to confirm that whether the drop in the KRE is going to continue or not? I have a pretty sizable position at 65 for July 18th. Okay, so we got to be careful with that, because if you have a pretty sizable position, then I would look at bond yields. So long as they go down with this kind of acceleration is not good for KRE. But if bond yields rebound a little bit, that's going to be your sign that yes. So we look at the 10, we'll look at the 30, even the 2 to a certain extent. And if we begin to find recoveries in yields, that's probably going to be a sign that at least in the short run here, the damage is done in the KRE and it's going to begin to rebound. So if you have a big position here and you're already sitting at profits, you want to trim a little bit. I would take 50 off right now. If there's another drop tomorrow, we'll take the whole position out and then we'll wait for a rebound and re-enter again. Maverick, is the NQ, the NASDAQ futures, E-mini futures, and gold futures correlated? It seems they move together. Yes, they do, but with a variation. And sometimes we see gold outperforming while we see the indices not, because gold is considered safety. But all in all, they kind of trade together, of course, with gold holding way better ground than equities. So what you're going to see in the next period of the stock market right now, the gold and the NASDAQ, the SPY, the performances will begin to diverge a little bit. We see the indices in a bear trend, but gold building a bull trend. So that kind of correlation will shift really soon. USNN says donut, DNUT got kicked in the D-nuts. I know you were a fan of going long on this. So I'm still long, by the way, and I'm down about like 40-50% of the position. It's just lucky for me, it's a smaller position. But what about now? Is it time to buy? If we look at this chart right here, I don't want you to be fixated on it because, again, it should be a smaller position. It's a falling knife right now. We're not seeing any sign of relief. And again, it's a store, it's recession fears, so there are a lot of problems with it. We don't want to add to it right now. We don't want to do anything with it here. Of course, if you have a position in it that you're not comfortable holding anymore, of course you should sell. But if it's a small position, you're down in it, we got to see better signs of life from a technical chart perspective before we begin to even entertain the idea of averaging down. J. Bratter, what idea you have for the CPI play? Do you think a rebound play would be a good one? So a rebound will happen if the CPI is not too hot and it's not too cold either, because what we want from the CPI is to rebound yields. Because if the CPI is way too cold, all of a sudden that's going to be because of a recession going on. If CPI is way too hot or hotter than expectations, then we have stagflation. That's going to be bad. That's going to pop yields for the wrong reasons and then hurt the equities market. So today could be, unfortunately, yes, it could be a recipe for a rebound, but it has to be kind of as expected, a touch lower than expectations kind of CPI. Anything above, I think that if we get a pop in the yields for the wrong reasons, such as a hotter CPI, unfortunately, the market is going to break. And the VIX is going to pop significantly higher, 40s, 50s. Now, if the CPI comes out milder, maybe we can debate, hey, we can have a rebound. We can have no risk right now of inflation. It's just recession fears, and those are going to subside at some point with more clarity in the policies and all of that. We can debate our way out of it for a rebound. And again, it's going to be the same rebound plays that we talked about today. But there's the other scenario too, so you don't want to go all in here, betting on one outcome. Folks, we're at 9:33. I'm going to look here at 9:33 Pacific time. I'm looking at the SPY 3 minutes. We got that rejection of 560, which is my number for, okay, now we can do a rebound with comfort, at least some degree of comfort, better degree of comfort. We have to look at all of these indicators that I gave you in the morning brief. But right now, it doesn't look likely. But the market maker doesn't want to break 555 either, because once we break 555, then the risk of 550 becomes really real. That we could have a short squeeze, or excuse me, inverse gamma squeeze, not a short squeeze, inverse gamma squeeze. So I think right now the market maker wants to trade between 555 and 560, go back and forth, and see how it holds, see who's going to have the upper hand and force the market maker one way or the other, based on the volume of the zero DTEs right around here. Right, so you have to look at the volume. Is it increasing here in slightly out of the money calls, or is it increasing at slightly out of the money puts? And are we hitting the bigger numbers like 555 in the open interest? Because that's the number where we get a squeeze to the next one, which is 550. So important to keep an eye on 555 today. Now, let's see here. Comics with Steve says, I'm up on most of the stagflation portfolio stocks I entered. I would like to add more shares. Should I consider buying more, even if it means cost averaging up? Yeah, at some point you should, but not right now. I'd say right now the best thing you can do is to sell covered calls and buy some puts as protection, collar strategy, which I spent a lot of time overnight, by the way, doing a video for you, which you guys are going to like, so almost done with that. But right now, you're not at that point yet. If we make a higher low, we rebound again, then yes, it's worth averaging up. Scott, have you looked at any diagonal calendar strategies? Yes, we can look at the diagonal is pretty good, specifically if you think the market is going to go down, and for example, you have SPY puts, you have them, let's say, for April 17th, and you got the 555, for example. You can sell the 550 as a debit spread and raise by $1,300 or so. But I like to do them diagonal, so I'm not limiting myself here, limiting my gains. So diagonal meaning you go to a nearer expiration date. And that way here, in this case, in the diagonal, you're raising 8 instead of 13, which is pretty good. The idea is we're not going to go below 550 by the 21st next week. If you believe that, then the diagonal makes sense. Small family office, please mention the unlimited loss for inexperienced shorties. Yes, if you short a stock, you got to remember the example that I just said with Palantir. If you borrow the shares, as I did at 115, and then it trades above 115, that's a loss, right? It's flip the chart like this. You buy a chart at 115, right? It goes below, you're at a loss. But the problem is when you're short and you're at a loss, it's not your money, it's the broker money. So there's a margin requirement. Every time it goes down, the margin increases. And if you don't have margin in your account, what's going to happen is they're going to try to sell your stocks or give you a margin call. You don't want to be in that scenario. So easier way to hedge against it is you short, and then you complement or you protect your position via calls. You buy naked calls as a protection. We can talk about these strategies a little more when we talk about shorting strategies. But hey, Mav, what do you think could be a good entry for ZBAR or ZPRA puts? Zebra. Yeah, if that's not a good entry level, then what do we do? This is an interesting company because they do the scanners and all of that, but it's been a falling knife. Do I enter puts at this point? It's a little oversold for my taste, outside of the bands. Risk versus reward would say maybe you enter right here, you see a rebound, and then you go down. So I'd rather wait for a rebound before I enter. And any failure within the body of the previous candle would be a good entry point at that point. But it might head down, look to 200 or whatever. But right now, it's a little risky to enter the puts at this point. Hey, Mav, I'm down 17%. Pretty big for me in Oracle. Should I try to average down a little bit, hold till a bounce, or cut the painful loss? So if you look at Oracle, look at this point, if we're down 17% and we have a rebound on a bad earnings report, and it looks like a bottoming candle, I want to give it a little bit of time here to allow for the rebound to happen. Now, you might rebound back to the 200 if we clean this up. You might rebound back to the 200 days moving average, and we see Oracle rallying and a bear rebound of about 10%. That's going to alleviate some of the pain. But I would now set a mental kind of way of thinking that my goal here is to cut my loss. So again, if you're brave, you think that this is a good sign and we might continue to go higher, then maybe you want to average down here. That way you don't have to wait till the actual break even for you to break even. Or if you're not sure, you can just keep the shares as they are and set a stop loss at the lows of today, 137.70. Because if we take that, then we have more pain to come. At that point, we have to exit. But so long as we have a promising candle right here, give it a few more days here and see if we can get a rebound to the 200, and that's going to reduce your loss a little bit. That way, when you exit, at least it's going to be less painful than what it is right now. I would definitely not exit today. Cali Fortune, I'm always too early. SPX 0DTE calls for a bounce. Looks like it could double bottom in the 5 minutes chart. Could be, depending on the volume. You need volume from the buyers, and so far I'm seeing just retail investors buying their names, rebounds of their names. I'm not seeing the professionals here shorting the VIX or taking their hedges out or buying calls on the SPY, so I'd be careful with that. 555, if you trade below, again, then you probably want to close your calls. WSM, gap close. What is a good entry? Length of the trade. WSM is Williams-Sonoma. Home builder getting hit pretty hard. It's beginning to frizzle out, so this one here, it's not oversold. If we plug in the bands, 200. So you might go down to the 200. I would enter right now, but I would give it a little more because we have a report coming here, right? So if you're confident holding through the report, then it's okay to go, let's say, the April. But I would say let's wait for this report because let's play a lotto in this report. So you play the 200 days moving average, you play the 160, for example, with the expiration date of, if it's going to report tomorrow, then you probably want to buy the weekly or next week. See how that works out. If it does, then either you short the name or you just expand on the put options. But right now with earnings, it's kind of tough because last time it gapped significantly higher. So you never know. That's a hard one. If there was no earnings, I would have said, yes, it's a good short. Let's take the 160, the April expiration, and or the 165, and it's going to work out. But because of this report, really tough for me to say. Folks, let's wrap it up right here. We'll be back in a minute in Discord in the chat session, though, so we're not going anywhere. And any update here in the market, look at this. 555 is now being taken out. And the VIX is beginning to find its way a little bit. Not good if you're betting on a rebound. Not yet, at least. We don't have the signs, all of them yet. But folks, again, I'll be in Discord in about 3 minutes or so. So we'll continue the conversation in the chat session. But for now, thank you everybody for joining. This was a great one. We covered a lot of good things. Good luck today. We'll be back again in a few minutes in Discord. Take care.